My name is William. I am your host and presenter for today. Today we actually have a special session coming up. I know I say this every time, but this time it really is, because so far we have been running these webinars every 2 weeks as we work in an agile mode by delivering new product enhancements every 2 weeks. We're now changing the frequency to a monthly iteration and relabeling it as Insights, where we will provide our newest product enhancements, but also other interesting topics and discussion points. So today, the latter is the case, because we have done some research, as you were able to see in the invite, and I'm personally very much looking forward to presenting you and telling you a bit more about this topic around fees. As usual, you have the option to use the chat in the bottom right to ask any questions, to raise any concerns or questions throughout this webinar. So let's kick off. As you have seen in the invite, today's Insights webinar is about fees. In our view, a topic that has received very little attention in the past. Now, you might remember already in fall, in October, we have done some research on how COVID has impacted the Swiss wealth management industry. We've done a survey there and presented that. So our ambition is to release such a report every quarter. And this quarter, we have now done some data analytics combined with conversations with some of you around fees. So in the scope of January to March this year, we spoke to 25 wealth managers across Switzerland of different sizes, different regions, and we've gathered some information both qualitatively, as I said, so we spoke to some of you, but also quantitatively using data insights from our platform where we aggregated analytics. And this is what you're going to see today. So the aggregation of average fee levels and some statistics on that. So I think it's quite an interesting topic because there's always a lot of chat, a lot of also media coverage on fees, how they have developed in the past and how they will evolve going forward. But there's not really any knowledge on what an average fee actually is and whether a Swiss wealth manager, where he lies himself or herself compared to a benchmark, if we can even call it a benchmark, but at least an indication. So our ambition really is to deliver a bit of market intelligence for you to get some insights on a topic that is normally not very well covered and for you to make better decisions. So regarding the flow for today, I will simply start briefly on the reasons why the fees are under pressure and therefore the margins are under pressure. And then I'll show you some data insights on what average rates look like across these 25 wealth managers we spoke to, and then providing solutions for the given problem or challenge. So I've pulled out some titles or some information from the media. I really don't want to paint everything black or put a negative picture on this, but I'm sure you're aware in the media there's a lot of chat around consolidation, around they even call it the price war amongst wealth managers, and so that's why, and that really triggered at the outset of why we ran this research is, you know, how can a Swiss wealth manager actually know whether he's in line with the market? Is there even a benchmark for fees being applied both on the management and the performance fee side? And what are the underlying drivers for this challenge or this competitive pressure in the fees space, and what are the solutions for the coming year for wealth managers to cope with that challenge? So that's the outset, and these are the questions we asked ourselves. And as follows, we would like to deliver some, at least try to deliver some answers. What I'm going to show today, of course, is not a suggestion in any way for you. It's more food for thought on how the industry is performing on the fees, and you can then derive your own conclusions out of that. So different sources in the media and in consulting, the big fours, there is some research on that, say that the AUM is expected to grow in the coming years. So that's a very good sign for all of us, of course. But the ratio of the revenue being derived from that additional AUM is at the same time declining. So PwC actually put a number on this and said it's 22.4%, sorry, until 2025. Now that is looking at the whole industry, the bigger industry, including fund management and also the institutional side. But nevertheless, it's set to decline. And the underlying reasons are, I guess, for you, nothing new, but I still listed them here. So obviously, the zero or even negative interest rate environment is a challenge, and their interest rates in the past have provided an annual risk-free return for investors. Now that is not the case anymore, so that is obviously a challenge for the wider industry. When it comes to transparency, of course, in the aftermath of the financial crisis, there has been a lot more scrutiny on the financial industry as a whole, and also on the wealth management and external asset management side. And already today, we see that there's more scrutiny from investors, more need for transparency, and of course the regulator also asking for more information and asking for more or challenging you more on the investor protection side. Then also not a new topic, of course, passive and robo investments. There's a lot of new ways of investing out there, whether it's passive or low fee products. Now we also have the crypto side appearing more and more. So these are more and more challenging the traditional way of investing, of course. And I think not to underestimate, but of course you are the best ones to assess, a new generation of investors emerging. So with growing middle class across the globe, and these people being very tech savvy and used to technological solutions, sooner or later they will also ask that from you. And with that also comes more transparency and accountability. They want to see how their money is invested, what the performance is thereof, and that ideally enhanced by technology. Regulation, as already said, obviously a major topic for all of us this year in Switzerland with the new FINMA regulation, FIDLEG FINIG. And this, of course, is also a factor that is depressing the margins on the fees, as the cost side is increasing to cope with these regulatory guidelines. And last but not least, consolidation. I think it remains to be seen how severe that really is in the Swiss market, whether it's actually happening or not, or how severe it is. But clearly, actually already back in October also, when we did a survey on the impact of COVID on Swiss wealth management, 26% of the respondents of our survey said that industry consolidation is a major concern for them. So it's not to be neglected, for sure. Right, so that is kind of setting the stage. I'm sure there would be much more reasons or criteria you could add here from your own experience, but let's dive now into a bit more the hard numbers. So there is some research specifically also on fees in the Swiss market. The University of Applied Sciences in Lucerne has done some research, but also there they have done a survey on the broader industry, so fund management, institutionals included. And there the argument was that also the vast majority of the industry is deriving their revenues from management fees. Now, our research really focuses only on the external asset management space, which is something new. We didn't come across any figures or hard facts on that. So that's why we want to display here a bit more tailored the information. And as you can see, although it mirrors very much with what the University of Lucerne has found out, that 85% of wealth managers apply management fees, and a smaller fraction combine that with performance fees. And I think the reason is, I mean, you know very well that for performance fees, it's probably more wealth managers applying those who invest in very product-driven strategies, or also thematic strategies and investments where a performance fee is more justifiable. Now, when we come to the hard numbers, again, these are objective numbers taken from 25 Swiss wealth managers. And as you can see, we divide it here by advisor and discretionary mandates. And quite obvious is that, of course, the advisory mandates are less charged, with 0.46% against discretionary of 0.72%, and similarly for the performance fee that differs on the two different types of mandates. Now, if we drill a bit deeper, I said this is the general overview, but now what happens if we look at the population or the wealth managers who only apply management fee and no performance fee? Then it looks already a bit different, in a sense that the average management fee for advisory mandates is 0.52%. So this includes now all types of strategies, all types of portfolios. It's really just looking at the advisory and the discretionary respectively. And as you can see now, I think, and that's also a novelty regarding the depth of this information. When we look at the asset bucket size, as we call it, so this would be like more or less the client size. Obviously, the average management fee decreases with the increasing client size or asset bucket size on the left-hand side. And also the riskier the strategy is, the higher the management fee. Now, we've aggregated these numbers, of course, for different wealth managers. Balanced or growth could mean a slightly different allocation, but nevertheless, it gives you a ballpark, an idea on where the aggregated average management fees lie for these different strategies. Digging a bit deeper even, we looked at now, so before we've seen the management fee only level, but what if a wealth manager combines management and performance fee? Then it looks as follows, that again here, similar picture and quite logic, that with a lower number of asset or client size, the fee is higher. And the same goes for the performance fee, where the fee level obviously increases with a bigger asset or client size. Now, I think also an interesting approach is the bottom table, where we see, okay, how does actually a wealth manager that uses management fee only compare with someone who combines both types of fees on the average level. So we see here that for those guys who are using management fee only, we have a slightly higher average management fee, which makes sense, because for those who combine it with a performance fee, they have another source of income through the performance fee. Hence, the management fee is slightly lower. Now, this one here is irrespective of the size or the strategy, but it gives you, again, an idea on aggregated numbers. So far for kind of the hard numbers. By the way, we are planning to publish this report in the course of this month still, so you'll have you'll have this information at hand and you can dig deeper into what is being said in the report. Today is more about giving you an idea and a sneak peek into our research on this topic. Now, as said, we don't want to put like everything negative or on a bad picture. Quite the contrary. Now we have seen that there's a challenge with the fees being under pressure, margins being under pressure, and these are the current fee levels aggregated. Now, what are the potential solutions to ensure profitability and ensure the revenue sustainability of your fees? And there are several reasons several ideas that can be brought forward. So first of all, a big topic also in some of the research we found is transparency. So EY, for example, suggests that 56% of investors don't really fully understand the fees they pay. It might be because they don't really have much of awareness of how financial markets work and how, therefore, their performance or management fee is derived. And that's why also actually some of the wealth managers we spoke to really openly communicate how their fees work, how they're exactly using the fees they charge to ensure their operations. And because clearly fees and transparency, the transparency of fees are in the end a trust business, so that your clients understand what they're paying for, what the value is of the relationship they have with you, of the knowledge they derive from you, from your advisory relationship. So trust is obviously the most important currency in your relationships. So that's why transparency, I think, is a big topic and important enabler to increase your client base as well. Then actually looking at some other markets across the globe, there are also other models of fees applied. So for example, per hour rates, or some of them actually also apply subscription packages where you can switch easily in between. Now that is really more also like food for thought suggestion, but I wanted to put it here because nevertheless, there are ways to innovate in the ways you charge your clients as well. Of course, transformation through technology. I will get to that in a second. But also, I think an important point is the investor experience. So that's not only regarding just the fees, but the whole experience they have in general. And again, there with driven by the pandemic, where of course you had limited options to meet your clients, they got used to digital interaction privately and in business, and this digital interaction will also translate, or if it hasn't yet, to your relationship to your clients. So the digital experience, we believe, and also some other research believes, is of course very important to keep your clients happy and to also set you apart from the competition. Now, I think here what's also an interesting example would be that where you have, for example, an advisory client and you want to push them towards, or you want to make them raise their interest into a discretionary mandate, there you could, for example, through the digital investor login, you could provide different strategies or show how you would have allocated it differently, show different types of products and structures and strategies compared to their status quo, all of this in a digital way so they can check it from their couch. I think these are very powerful new ways of interacting with your client. And yeah, of course, the return, providing stable, above average return is of course self-evident as a driver for ensuring profitability. Okay, so now we've said kind of these were the different topics: transparency, digital investor login, and also in the end return that are providing the return, sorry, the performance on your side. But I think how does that actually look in daily business? How does the transformation through technology look in the daily business? So below here, you can see just a few of the examples or topics that help you to really use technology on a daily basis. So it's not only for the fees or the invoicing of your clients. Of course, their solution like ours, as you know, allows to automate and customize invoicing in different languages, and also very much, adding personal notes, white labeled with your logo, but also it has functionalities of ensuring accounting and profitability over time. And then the other important workflows, of course, are also driver of the whole effort of making operations as smooth and efficient as possible, to also increase the happiness and the satisfaction of your internal team members as well as of your clients. So I let this sink in with the different transformation options through technology. And I will simply wrap up now what I've said before. As I said, you can access the report still this month and have a more deep dive into this topic. But just simply to wrap up, so we've seen that the assets under management are set to increase over the coming years. So that's great, that's good news. But the margins are set to be under pressure due to these different reasons that I've mentioned, whether it's consolidation, fierce competition, and regulatory challenges ahead. And we've also looked at some average numbers that are an indication on where the industry is currently at on the fees. But I guess you best know how the fees have evolved over time, but this gives you kind of a snapshot of how it looks now amongst 25 of your peers. And really, I think for the way forward, we've seen that we have different options to fight this margin pressure, whether it's on the transparency of the fees, whether it's the innovating the ways you charge the fees, or whether it's through technologies like ours that help you really streamline daily workflows, make them automated as much as possible, and which will give you the focus on the markets and of course on building great relationships with your clients. So this brings actually today's session to an end. I would like you very much for your attention. I don't see any questions in the chat, so nothing to follow up on. I would like you also to bring forward your suggestions. If you have topics that interest you, where you would like to have some insights or some research, we and I are very happy to pick that up, whether it's on a specific topic such as the fees or different strategies, how to really give a bit of market intelligence to the industry. That would be very much appreciated or well received if you have any such ideas. So with that, I would like to close for today. We will see each other very soon for the next webinar, and hopefully even before that, now that everything is easing up, hopefully also in person. And I wish you a very nice weekend ahead. It's set to be good weather, so make the best use of that. Thank you very much, and see you soon.